Index fund, ETF, mutual fund. People throw these three words around like they mean the same thing, and then use every one of them wrong. You'll hear someone say, I bought an index fund, and I bought an ETF, as if they're two different choices you have to pick between. They're not, and that confusion isn't harmless. It's exactly why people freeze at the buy button, or worse, pick the expensive version of the same thing and quietly bleed money for decades. So let's untangle this once and for all. Because here's the secret that makes the whole thing click, and almost nobody explains it plainly. These three words aren't three competing products. Two of them describe the same idea, just packaged differently. The differences that remain are real, but they're small. How it trades during the day, what it costs to own, how it's taxed. None of them are complicated, but each one can quietly cost you or save you money over a lifetime of investing. By the end of this video, you'll know exactly what these words mean, how the wrappers differ, and which one you should actually buy. We'll settle it in 5 factors. No jargon left standing. Here's the single insight that fixes everything, and once you see it, you can't unsee it. Index fund is not the same kind of thing as ETF or mutual fund. It's answering a completely different question. An index fund describes a strategy. It tells you what the fund does with your money. Instead of paying a manager to guess which stocks will win, it simply buys the whole market and tracks an index, like the S&P 500. That's the strategy. Own everything, cheaply, and stop trying to be clever. But ETF and mutual fund don't describe the strategy at all. They describe the wrapper, the container the strategy comes packaged in, how you buy it, how it trades, how it's taxed. That's the wrapper's job. So here's the part that surprises people. An index fund can be either an ETF or a mutual fund. They're not rival choices on the same shelf. One is the recipe, the other is the box it ships in. You can get the exact same S&P 500 index strategy as an ETF or as a mutual fund. Same holdings, same idea, just a different package. So the real question was never index fund or ETF. It's 2 separate questions. First, what strategy? And for most people, that's a low-cost index. Then second, which wrapper? Let's break the wrappers down. The first real difference between the 2 wrappers is when and how they trade. An ETF, that stands for Exchange Traded Fund, trades like a stock. All day long, while the market is open, it has a live price that ticks up and down, and you can buy or sell it at that moment's price. 9:30 in the morning, noon, 2 p.m. Whenever you want, you see the price and you click. A mutual fund works completely differently. It only trades once per day. No matter when you place your order, morning, lunchtime, an hour before close, it all gets filled at the same single price, calculated after the market closes. That price is called the NAV, the net asset value. Basically, the total value of everything the fund owns, divided by the number of shares. So with an ETF, you trade in real time at a live price. With a mutual fund, you get in line during the day and everyone gets the one closing price. Now, does this actually matter for you? For a long-term investor, honestly, barely. You're buying to hold for years. Whether you got the 10:15 a.m. price or the 4 p.m. price is noise. The intraday trading of an ETF mostly matters to active traders, which, if you watched our investing video, is exactly who you're trying not to be. But it's the most visible difference. So now you know what's really going on under the hood. Now, the difference that actually moves money: fees and minimums. Every fund charges an annual fee called the expense ratio. And here's the good news. For broad index funds, that fee is tiny whether it's wrapped as an ETF or a mutual fund. We're talking a few hundredths of a percent. Roughly $3 a year on every $10,000 invested. That's the kind of cost you want. The trouble starts with the expensive funds people get talked into. Some mutual funds, especially older ones, or ones sold by a commissioned advisor, carry a load. A load is just a sales fee skimmed off the top, sometimes 5%, the moment you buy in. 5% gone before your money does anything. And some mutual funds also require a minimum investment, $1,000, $3,000, just to get in the door. An ETF, by contrast, usually has no minimum at all. You can buy a single share for whatever it costs. And the expense ratio gap is the real killer, because it compounds. A fund charging 1% a year versus one charging 0.03% doesn't sound like much. But over 30 years, that gap can quietly swallow a quarter or more of your final balance. Tens, even hundreds of thousands of dollars, handed over for nothing special. So the lesson isn't ETFs good, mutual funds bad. It's hunt down the fees. A low-cost index mutual fund and a low-cost index ETF are basically twins. It's the loaded high-fee funds in either wrapper that you run from. Here's a difference that's invisible until tax season, and it only matters in one specific situation, so pay attention to the condition. In a regular taxable brokerage account, ETFs are usually more tax efficient than mutual funds. The reason is plumbing. When other investors sell out of a mutual fund, the fund sometimes has to sell its underlying holdings to pay them. And that can trigger capital gains that get passed along to everyone still in the fund. So you can owe tax on a gain you never actually cashed out, a surprise capital gains distribution, just for holding the thing. ETFs are built differently. Their structure lets them avoid most of those events, so they tend to hand you far fewer surprise tax bills. Now, here's the giant asterisk. This only matters in a taxable account. If you're holding your funds inside a retirement account like an IRA or a 401k, none of this applies. Those accounts are already shielded from year-to-year taxes. So a mutual fund's capital gains distributions don't touch you at all. Inside an IRA or 401k, ETF versus mutual fund makes zero tax difference. So the rule is simple. Investing inside a retirement account? Ignore this factor entirely and pick whichever's cheaper and easier. Investing in a regular taxable account where you'll be holding for years. That's where a broad index ETF's tax efficiency can quietly give you an edge. So after all that, which one do you actually buy? Let me make this genuinely simple. For the vast majority of people, the answer is the same: a low-cost, broad index fund. That's the decision that matters by a mile. Get the strategy right, own the whole market, keep the fee tiny, and you've won 90% of the game before the wrapper question even comes up. And here's the freeing part. Once the fee is rock bottom, whether it's an ETF or an index mutual fund barely matters. They'll perform almost identically, so don't agonize over it. But if you want a clean tiebreaker, here it is. Lean ETF if you're investing in a taxable account, or you like the flexibility of buying a single share at a live price with no minimum. Lean Index Mutual Fund if you want effortless automatic investing. Many mutual funds let you set up invest $50 every payday, and even buy fractional dollar amounts on autopilot, which is fantastic for just setting it and forgetting it. Either way, you end up in the same place. Cheaply owning the entire market and letting time do the work. The wrapper is a footnote. The strategy is the whole story, so stop letting three confusing words keep you on the sidelines. You now understand them better than most people who've been investing for years. So let's lock it in. Index fund is a strategy. Own the whole market cheaply. And it's the part that actually decides your results. ETF and mutual fund are just wrappers. Two different boxes the same strategy can ship in. An ETF trades live all day. A mutual fund trades once at the closing price, and for a long-term holder that barely matters. Watch the fees like a hawk and steer clear of loads and high expense ratios in either wrapper. ETFs tend to be more tax efficient, but only in a taxable account. Inside an IRA or 401k, it's a non-issue. And for almost everyone, the right move is the same: a broad, low-cost index fund as an ETF or an index mutual fund. Same destination, slightly different box. If this finally made these three words make sense and saved you from overthinking a decision that was never that hard, hit subscribe. That's the whole point of this channel. The money stuff nobody bothered to explain plainly. Next up, capital gains tax explained. The real difference between short-term and long-term, and why holding just a little longer can hand you a much bigger tax break. I'll see you there.